Alright, let's be honest. Have you ever been up late just scrolling through Zillow and you see these so-called starter homes for $500,000 and you just have to ask yourself one thing? Well, spoiler alert, it is not you, it's the math. And trust me, the math it's brutal. So today, that's what we're gonna do. We're gonna break down who can actually afford a $500,000 house. And I'm not talking about who a bank will give a loan to because that's a whole different story. Yeah, see, there's this huge, and I mean a massive gap between what the bank says you can borrow and what you can actually afford without that 3 a.m. cold sweat, you know? The one where you're just staring at the ceiling. Okay, so let's just rip the Band-Aid off and start with a really uncomfortable truth. In a ton of places across the US, 500 grand is basically the starting price for just a normal, regular house. But the median household income, it's sitting at around $84,000. Just think about that. We're telling people they should be able to afford a house that costs almost 6 times what they make in a year. If that sounds completely insane to you, well, you're paying attention. That's a good sign. But here's the thing, right? Your mortgage broker calls all excited, you're approved. The real estate agent is telling you, it's a great time to buy, prices only go up. Maybe your parents are even chiming in, you've got to get on that property ladder. So, what gives? What's the real problem here? Well, the problem is that just about everyone in that equation makes money when you buy the house, which means they're all kind of incentivized to, let's say, stretch the definition of what affordable really means. All right, let's really get into the weeds now. We're gonna build the true monthly cost of one of these houses, brick by painful brick. Because most people, they just see that first number the lender gives them, and they stop there. But that's a huge mistake. So let's say you've been saving like crazy, and you've managed to scrape together a 10% down payment. That's $50,000. So you're taking out a $450,000 loan. Your base payment, just the principal and interest, is gonna be right around $2,850 a month. Okay? That's our starting point, but we are nowhere near the finish line. First thing we gotta tack on, property taxes. And let's be conservative here and say that adds another $500 a month. Every single month. Yep, that's just for the privilege of owning the patch of dirt your house is on. Okay, next up, let's layer on homeowner's insurance. And if you've been watching the news, you know these rates have just gone through the roof lately. We'll pencil in another $300 a month for that. And that's a good deal, assuming you don't live anywhere that has, floods, or fires, or hurricanes. And now for my favorite part, the cost everyone totally forgets about, until the water heater decides to give up the ghost on a holiday weekend. You've got a budget for maintenance and repairs. A good rule of thumb is the 1% rule. Budget 1% of the home's value every year. For our $500,000 house, that's another $417 a month you need to set aside. And last but not least, because we only put 10% down instead of 20, we get hit with PMI, private mortgage insurance. You can basically think of this as a thanks for not being rich tax. It's another $300 a month for an insurance policy that, get this, protects the bank, not you. So, let's do the big reveal. Let's add all that up. Your actual, true, all-in monthly payment isn't that $2,850 number you first saw. Nope, it's $4,367. Just let that number sink in for a second. And remember, that's your payment when everything is going perfectly, before anything breaks. So that leads to the big question, right? Who on earth can actually afford a payment like that? This is where we get into the really brutal math. Let's work backwards from that $4,300 payment and see what kind of salary you actually need to make this work. Okay, so most financial advisors will tell you the smart conservative rule is that your total housing cost shouldn't be more than 28% of your gross income. To hit that target with our payment, you need to be making $187,000 a year. Now the banks, they'll let you stretch it way out to 43%. But even with their super risky rule, you still need to be pulling in $150,000. So what's the big takeaway here? What does this all mean? Well, as you can see, only about 20% of all households in the entire country even clear that riskiest bar of $150,000. That leads us to a pretty terrifying conclusion, doesn't it? What we call a starter home is now financially impossible for about 80% of American families. So let's take this out of the world of spreadsheets and numbers and see what it actually feels like to live this way. Let's talk about what it means to be house poor by looking at a hypothetical family. We'll call them the Johnsons. Now, the Johnsons on paper are doing great. They make $160,000 a year combined. That's a great income. But after taxes, health insurance, putting a little away for retirement, their actual take-home pay is about $9,500 a month. And that housing payment we calculated, that $4,300, it's eating up 46% of their monthly paycheck before they've bought groceries, put gas in the car, or done anything else. And this is what being house poor really feels like. It's that little knot of anxiety in your stomach when you're at the grocery store pulling up your banking app before you go to the checkout line. It's having to tell your kids no to soccer or ballet lessons because what if the car breaks down? It's that 2 a.m. terror, where you're just lying there thinking about what happens if just one unexpected thing goes wrong. A medical bill, the AC unit dies, and your whole house of cards comes tumbling down. Okay, so what in the world are you supposed to do when the math is this broken and the whole game feels rigged against you? Well, the first step, the most important step, is you have to take a step back. You have to separate the pressure everyone puts on you from the cold, hard mathematical reality. We've all heard it a million times, right? Renting is just throwing money away. That's the societal pressure. But here's the mathematical reality. Since 1990, home prices are up 400%. Meanwhile, the median income, up only 180%. Listen, you can't just budget better to fix a gap that big. This is a structural problem. And what that means is, maybe we need to redefine the American dream a little bit. Maybe true wealth isn't having all your money locked up in the drywall of a house that's stressing you out every single day. Maybe true wealth is having some breathing room in your budget. It's being able to sleep soundly at night. It's having freedom and choices. Don't ever confuse being house rich on paper with being truly wealthy. And the good news is you have options. You can actually choose not to play this crazy game. You can keep renting for a while and invest the thousands of dollars you're saving every month. You could look at a smaller house or maybe a totally different, more affordable city. The absolute key is to stop letting the bank's approval letter dictate your life and start listening to what your own budget is telling you that you can sustainably and happily afford. So, the next time you find yourself doom scrolling those real estate apps late at night, I want you to pause and ask yourself one really important question. Is chasing the specific house going to help you build the life you truly want, or is the crushing cost of it actually going to trap you inside its walls? Because at the end of the day, the real win isn't just getting the keys. It's making a choice that's based on your reality and your math, not just someone else's dream.